Welcome back to the course Introduction to Commercial Banking and FinTech. In this particular course, in the last session we tried to understand the market operations, how it happens. So, open market operations. We also looked at operation twist, the debt management, how RBI does, and market stabilization scheme. We also looked at how the foreign exchange market plays important role and how RBI plays. In the last session toward the end, we started with this topic that we will be continuing in this particular session, which is about foreign market operations and the intervention tools that we are discussing. So, we are mentioning that RBI, if RBI is selling to the dollar, then they will be buying the dollar later at a much cheaper price, and if they are selling today the US dollar, so they will be buying at cheaper price. When they are buying today dollar, then they must be selling at higher price, so that some spread that they gain. So, this is also one of the important sterilization measures that we are seeing. So, neutralize INR liquidity. So, sterilization measures, since I am mentioning sterilization word quite frequently. So, let us understand what is neutralization means. Neutralization in the sense that whatever excess liquidity or excess amount of money is available in the banking system, if it remains in the banking system, then it will create inflation, because MV is equal to PT we know already. But if what measure should I take that without harming anything in the system, repo rate, reverse repo rate, nothing, we are able to sterilize the whole amount, excess amount from the banking system. So, this is what sterilization means. It prevents excess money supply growth while maintaining foreign exchange stability. So, instruments are CRR hikes, so cash reserve ratio hikes. So, this is what here we have, observed liquidity versus bank reserves. Second is the open market operations. So, first one we know that CRR, we are talking about cash reserve ratio, right. So, RBI tells banks to maintain this, and this is mandatory, right. So, this is how they observe the excess liquidity from commercial banking. Then open market operation, we know that it is market operations, buying and selling of the government securities. Whenever RBI feels that the excess liquidity in the banking system, then they will be selling the bond, and then they will be taking money from the banking system into, and then they will be having the bond only. So, this is what they will be draining the liquidity. Then market stabilization scheme, we know that if you have foreign inflow coming, rupee has appreciative move and it is going to harm the businesses and others, then in that case it will also sell the bonds, so that bank, and it will tell the banks to buy those bonds, MSS bonds, and as a result liquidity is being observed through these bonds. So, this is how it happens, right. So, this is how it works in real life. Then here we have the operations, how it works. So, mechanics and liquidity we are going to talk. So, a spot purchase of USD from banks. So, RBI will buy the USD from bank reserves, right. So, what will be this, that forex reserves will go up, base money will also go up, and this if it is not, so this is like RBI injecting money when they are buying dollar, right. A spot sale of the USD, so to banks, so which means that RBI sells USD, and this will be right reduction absorbing the liquidity. So, this is how they are going to do when they see a decline in, so this is like foreign inflow kind of situation, right. So, a spot operation is like this, that they will be buying immediately. So, for example, if we are thinking about MSS bond, so let us rule out if we have a foreign inflow, your surplus will shoot up, forex surplus will shoot up, and as a result forex reserves, you can say FX. As a result, if this continues, then this is going to impact the inflation or other factors. But in turn, what is the meaning, that it means that RBI will have to now buy dollars to maintain this extra money in the economy, and as a result banks are going to have this money, because this will be facilitated through bank. The opposite case would be the selling. Suppose you have the excess surplus, so you purchase the bond now, but RBI it may happen that after one day situation improves and RBI wants to sell, so that is also possibility. But this could be an independent decision also. So this is one situation we are seeing inflow. This is when we are seeing outflow. So this is what. So RBI sells US dollar and buys rupee, right? And this is how it happens. So when dollar is getting stronger, it means the rupee is weaker, and when a dollar is weaker, it means the rupee is stronger. So this is, you can think in that sense, right? So this is what. So selling means absorbing the liquidity, buying means creating or injecting the liquidity. So what is that? That whatever is the situation, it should not lead to excess volatility. So RBI has to act on this excess volatility, and RBI's role is to act against this volatility, and this is how it happens. But sometimes it happens that there could be persistent fall in rupee price. Dollar may not be falling, some other factors may play a role. In the current geopolitical situations, you may see that despite US having a lot of awkward economic policies like tariff and geopolitical issues, you are seeing that dollar is still appreciating, right? So this could be one of the also exceptions, that how the US, despite having so many blockages, it is still having the dollar appreciation. It means that rupee is declining. In today's newspaper, I saw that rupee again went by 7 paisa to 88 point some odd number, and this is how we can see. And RBI's role is to maintain that it doesn't fall so much and it doesn't go so high. So this is how we manage. Then we are looking at some of the new measures that we saw in recent years, and those measures really helped us understand. So what is that? So here it is in terms of overnight liquidity adjustment facility that we have already seen with repo and reverse repo. Then RBI, especially during COVID-19, so during pandemic, we saw that so some challenges were occurring. One was the bond market disruption, especially the corporate bond market disruption. So majority of the bond holders were going for redemption, and this created, so you can say it was a tough time for the corporate bond market. So in order to give support to this particular ecosystem, some instruments were adopted. Second was the case of financial inclusion, because at that time economy was really in a bad shape, lockdowns and all. So and there were a lot of demand for the small finances, to meet the small finances. And then we know that in India we have a medium small micro small medium enterprises, so MSME we call it, or you can say small medium enterprises, SMEs. So SMEs also facing some financial deprivation. So in order to address their need, almost 1 lakh crore of the tapping was announced with certain longer duration like 3 years or so. So that these issues can be tackled easily, and later when the economy recovers, then they will evaluate whether such measures were useful for learnings or other purpose. But our job in today's this session is to understand that why these measures were taken and how these measures get implemented in real life. So the key instruments for the targeted liquidity, as I mentioned, that bond market, you can say financial inclusion, the SMEs, financial deprivation. If you think about these keywords, then the instrument that we often call is called long-term repo operation. So LT that you are seeing, it is for long term, and RO for repo operation. Then here we have the targeted long-term repo operation. So this could be for MSMEs or in any other purpose. Then here we have the special long-term repo operation. This could be your for the financial inclusion and other purpose. So small finance banks were given, right? And there were also the refinance windows wherein the institution specific guidelines and institution specific support were provided. So this is how it worked. So let's understand first the LTRO, long term repo operations. So structure was the term repo with RBI. So this you can say, so we saw 7 to 14 days, right? But here we are saying that term repo it goes like 1 to 3 years. Collateralized by G6 T-bills is going to be so this that we are seeing this particular instrument, it is collateral based instrument. It is not the, you can say, standard deposit facility kind of. It is the collateralized, and because it is repo just for the long term, so it is collateralized with government G6 and T bills, and it goes by auctioning. So auctioning could be like, suppose LTRO has RBI has based on the government instructions, RBI has gone for 1 lakh crore of this LTRO amount. Now banks will be allowed to bid, and the maximum bidder, the highest bidder will get the first preference, then lowest, and lowest will get the least. So this goes by auctioning, right? Now here you have to understand that you have to show the newness that you are doing into the system. So you got money, but you cannot just put that into clearing a debt or any other thing. You have to show that this money has been used for a specific purpose, specified directly or indirectly by the RBI. So some amount of additionality is being added here, that with this amount of money, what additions are you creating? So for example, if it is given to corporate bond market investment, so investable grade bonds you have to select and follow the guidelines of investment, then only it will be considered. So LTRO goes by that criteria. So TLTRO, right? So under this, the targeted long term. So targeted long terms are mostly for small financing, but it is mostly linked with the micro small enterprises. And here you have the, so deployment happens through, so whatever amount of money that you are getting from the RBI at a collateralized loan, this has to be invested in commercial papers, non-convertible debentures, so NCD, it is also a long-term borrowing instrument. Then NBFC, non-banking financial corporation, housing finance corporation. So all these institutions also issue the bond. In India, if you ask me that, because I am talking about corporate bond market, because I am asking about corporate bond market, so here it could be, so in India, AAA rated bonds are considered as investment category bonds. Investment category bonds, right? And it is also called as, if they have AAA rated bonds, mostly done by CRISIL and ICRA. So CRISIL does this job, then ICRA also does this job. So AAA rated bond, it is also called as a risk free. What is the definition of risk free asset? So definition of risk free asset is any asset which has the standard deviation low or 0, that qualifies as the risk free asset. So it could be a fixed deposit with RBI, it could be government bond, it could be any asset. So in case of government bond, we know that it is guaranteed by government. So most of the government bonds are considered as a risk free asset. because it is granted by government. In the same way, if you have the triple A rated bonds, rated corporate bonds, then it is also called as a risk free bond. But there are exceptions to this, because Lehman Brothers before collapse, it also had the triple A rated rating, and we had in 2018 NBFC crisis, mainly by IL&FS, Infrastructure and Leasing of Financial Services. Now, this particular company, before the default, uh, it also had the triple A rated bond. So these are some of the negatives of the corporate bond market that we often experience in India and even globally. But for investment grade bond, you can say triple A rated corporate bonds are considered investment grade bonds, and the amount that you are getting under targeted lending or targeted long term repo operations, which is a collateral based loan, then it must go to. So it is saying that you invest in commercial paper, which is the uncollateral security, and NCDs, non convertible debentures, NBFC and HFC bond, housing financing corporation bonds, and MSME linked assets. So it could be of any type, which could be like their asset, which means that whatever collateral they can provide, so that you can think about, right? And then and some of the, we also have the some of the MSMEs also issue, if they have taken, if they want to borrow money, then they will be putting some collateral, so you can think about that kind of investment. It was implemented first in March 2020, when we had when COVID was surging at that time, and it had become one of the important. I think World Health Organization had declared by March 2020 the global pandemic. At the same time, in March 2020, we were also having the lockdown, so it also created a lot of negatives. So at that time, this policy was announced. Then again, April 2020, we announced the TLTRO. So if you read the economic survey, that time of 2020-21, it mentions about these measures. So these are unconventional measures. Then on tap, which means that if it is for 3 years, then you can borrow 20,000 now. Then again after 1 year you can borrow. So on tap means that it is continuously flowing. So you can borrow whenever you want, but make sure that it goes to the justifiable activity. So this is how it goes on. Then here we have the SLTRO, which is the special long term repo operations, and it was mainly meant for financial inclusion. So if you want to read about financial inclusion, so Raghuram Rajan committee has given, so you can say, you can think about financial inclusion. So here you have C Rangarajan committee, on financial inclusion, gave a formal shape to this, and gave a formal shape. But we know that the financial inclusion in India back in 2007-8, it was one of the areas where the government has maximum emphasis, but then we saw that there was a scam, some kind of crisis in the financial inclusion industry. Mostly the small finance institutions created trouble, and as a result the government had to put regulations in place to make sure that only the targeted community gets the benefit. So sometime the small finance banks, which are meant for financial inclusion, sometime they go for so it is this money is being used for the micro borrower lending and also to MSME, micro small medium enterprises, and it is also one of the important objectives for the social welfare and the, you can say, economic inclusion. So this also helps in understanding about it, and this gives the summary of the all these measures that we mentioned. So one is called the long term repo operations, then targeted long term repo operation, and a special long term operation. So you can see 1 to 3 years is the tenure, right? So tapping is that you borrowed in 1 year, then you can go also in the second year and third year. So up to third year you have this particular option available, and it happens through auction, right? Because it is repo, so it is collateralized, but at the same time it will be through auctions, and collateral that you have to give is the G-Secs, T-bills and all. Here it in especially long term, it could be any type of bond which the RBI notifies that these bonds are also eligible, and end users are this is for general purpose, that was given in March 2020, and these are for special needs, right? So this is what here we have, and of course the ultimate objective is to help the last mile. So, and what is the role of this? As I mentioned, that this is also the one of the important social objectives to mention about. So this is how we mention, and now we'll be getting into the new topic, which is the interbank borrowing and lending. So till now what we saw is that we were mentioning about RBI and the banking, or you can say RBI and you can say commercial banking, right? Now we will be looking at bank, for example SBI and Bank of Baroda, right? Or you can say SBI and HDFC. So borrowing and lending of money does not happen only between the central bank and the commercial bank, it also happens between banks, and this is what we try. So interbank, so interbank, which means that one bank is lending to another bank and making money out of it, right? So this is also, so if sometime it happens that when you are borrowing, when you want to auction to the suppose you have money requirement and RBI has notified that they are going for VRR, so variable repo rate auctioning in within a week, but you want immediate money overnight. If you go to the repo rate, it is costlier. So sometime the banks will also be hovering around with some basis points, and that basis point helps. So a lot of time, instead of going to the banks, going to the central bank, sometime banks within themselves they go for borrowing and lending, that we call it as interbank borrowing and lending. And one of the important instruments is the call money rate. So interest rate at which banks and other financial institutions borrow and lend funds overnight in the interbank market. What is this? Its shortest maturity is the overnight, and surprisingly those who want to work in this area, if you, one major difference that you have with the call money rate, so call money rate is the interbank rate, right? Call money rate is also called as CMR. Now if you go on RBI website, which is, and just look at database on the Indian economy, so here you have to note one major difference. Suppose you want to examine that how is the interest rate. So suppose you have taken the log of spot is equal to alpha 1, you have taken you have taken interest rate, you want to take interest rate, plus you have alpha 2, you want to take inflation, plus you have epsilon t. So let me write it down clearly. Log of a spot, what is spot? it is the USD INR is equal to alpha 0 plus alpha 1. Here we have the interest rate plus here we have alpha 2 and here we have the IT plus here we have the epsilon t. Now what we are seeing here? We are seeing here is that if you are looking at the IT, so if you download the data, so IT could be of the basket of interest rates, so it could be repo rate, it could be prime lending rate by the banks, it could be your call money rate, right, and it could be also the rate being offered on special loans, right. Now if you download the data of repo, so repo is not a continuous series, right. So repo is like RBI changed, suppose in 1 year you want, suppose you want to deal with the daily observation, daily data, right. So if you download the daily data, or suppose you want to deal with weekly data, if you download the weekly data, then you find that repo doesn't change frequently. So repo is 6%, so in next week and 6 and 6, so there will be a run of 6. But call me rate is like overnight, so it gives a continuous data, because this is decided by RBI. So RBI may not change rate of interest every time, they may sometime keep the rate of interest for a long time same. So you are having 666 values run, right, and this is what it plays an important role. And then here we have the CMR. CMR has the continuous series. So a lot of time in real life application, when you want to work on these particular type of issues, then you will find that you have the CMR call me rate playing, helping you such type of analysis. So this is where it is very important to note, especially those who are doing masters in economics. You must explore such experiments, and those who are BTech engineers or those who are just undergrad, you must learn about these things, that how which data is useful. You must go to RBI web page and try to see the data and how they look like, try to download in Excel, plot, play with it, calculate the growth rate, calculate the log of that series in Excel. So with this you will develop the interest, and you will also be simultaneously, whatever I am teaching, you will find everything over there on RBI website. So it will be a good practical learning for all of you. In such lectures it may not be so easy to add everything, but if you just explore by yourself, then it also helps a lot. So let's come back to the call my rate. So call my rate, the interest at which banks and other financial institutions borrow and lend funds overnight in the interbank market. So this is what it's called, call money rate. It is the shortest maturity, but it can go up to, it is called notice money, it can go up to 14 days. So overnight and up to 14 days. If it is up to 1 day or 2 days, then it will be called notice money. It is no collateral loan, uncollateral loan. So this is also one good advantage. If you are going through repo rate, then you have to have the collateral, until unless you go for the standard deposit facility, SDF, which is non-collateral, but it offers you less rate of interest, right. So if you are a lender, then you will be thinking about your payoff. So unsecured, it is one beauty, highly sensitive to liquidity conditions, which means that if every bank is having the excess liquidity, then the rate is going to come down. If banks are having less liquidity, then this rate is going to go up, because every bank will be looking for money, right. And this is what, and most importantly, it acts as a short term money market liquidity barometer. It is one of the important indicators, as I told, that it is having the continuous data on RBI website, and that's why it is very much useful to use such data. So this is what operation of call money market, how it works. So bank A faces temporary liquidity shortage. It borrows overnight from bank B in the call money market, and next day bank A pays what? Principal, how much it is borrowed, plus the interest at the call rate. Normally repo plus some rate 0.5 or something is being added. Participants are mostly the scheduled commercial banks, right, which are included in the schedule of the RBI. It can have both private and the government, both banks. Lenders, banks, insurance company, mutual funds, and the or public dealers that we have, right. And then, it is called primary dealers. So primary dealers, those who are involved in the borrowing and lending. And RBI monitors closely this, because otherwise if things are settled here in an unsecured way, then you will have the less participants in the repo market. So they also observe that what kind of liquidity absorption is taking place, and if they feel that it is harming so much, then they will be revising the repo rate up. As a result, the call money rate will automatically shoot up, right. So this is what here it shows. So overnight borrowing example could be bank A needs 500 crore overnight to meet the cash reserve ratio, right. Bank B has surplus liquidity and lends 500 crore, and call me rate in the market is suppose 6.5%. So what will be the computation? So it is for 1 day, so continuously compounded manner, 1 upon 365 here we have. So how much we are getting? So 500 crore, so how much in one night bank A, which has borrowed, will be paying to bank B 8.7 lakhs, 77 lakhs, right. So bank A repays how much? 500 crore plus 0.0877 crore, and this is how we have, right. So a small overnight change can indicate liquidity stress or surplus in the system. So this is one of the, you can say, important or critical. So CMR, call money rate, is one of the, as in the last slide I mentioned, it is the barometer of measuring liquidity in the banking system, right. So this is what we try and get here. So this is what we try to understand. Now if you try and read about the recent tools and techniques that we often try and capture. So one of the important tools that we in recent time that we are talking about is the communication tools. So what are those communication tools? So communication tools are basically the so over the years, as I mentioned in the last session, that with the development of natural language processing, a lot of new things have come up in the monetary policy analysis, and it is useful for the commercial banking also. So these are some of the new topics that we'll be learning, and one of the important objectives of this is that how do we shape the market expectations. So no one knows that what is going to happen with the policy scenario. Based on inflation, you can expect that okay, this time RBI will be taking a call and it will increase the rate of interest. But we have found on several occasions that RBI does not change the interest and it keeps the interest rate same. So the investors and all others entities, how they behave and how they play with it, it is also one of the important factors to examine. Second thing is that whatever the communication happens from the central bank side. So here we are going to focus only on the central bank, and we'll try to see that how bank and other entities absorb that kind of news, or you can say whatever shock they receive, how they deal with that kind of shock. So here it is about the policy transparency. So if whatever the monetary policy committee resolutions, whatever the press media statements, minutes of the meeting, whatever it comes out on the portal of RBI, different agents go through those minutes and reports, and they try to derive the nuances, the below between the lines kind of scenario, and they try to understand that what will be the next step for RBI. And it also talks about the future stance of the monetary policy, how it is going to be. So the key instruments for the communication tool of the monetary policy is, it is MPC resolution that we talk about. So here we are having the monetary policy committee resolution. So if you see the frequency, it is announced bi-monthly, and the policy rate decisions are always considered as so based on the bi-monthly, we often see that it is with regard to the policy decisions, that how it happens, and whether those policy decisions are accommodative, neutral, or non-accommodative. So here you have to understand two things. So here we are going to talk about two types of monetary policy. One is called expansionary monetary policy. Second is called contractionary. Monetary policy. Under this, what we are trying to see is that under expansionary monetary policy, when rate of interest comes down, your money supply increases. As a result, you see aggregate demand increasing, and as a result, you see aggregate output increasing, and this could be at the cost of higher inflation. But contraction monetary policy, rate of interest goes up, so CRR and repo rate, all everything is being revised. Money supply comes down, aggregate demand is expected to come down, Y comes down, and as a result you will have the pie also coming down. So this is what we try and capture here. So accommodative in the sense that whether it is expansionary or it is remaining same, so somewhere in interest rate is expected to come down or make it more, so it should not go up as such, and withdrawal of accommodation in the sense that it is focusing on contraction. Now you must be knowing that in business cycle, this is the business cycle that we normally see. In business cycle, here we have the peak and here we have the trough, right? Now peak and trough that we are seeing, so this is the recovery of the economy and this is slowdown. So during these periods, what you find is that during slowdown, you find here expansionary monetary policy playing very important role. During this period, you will find that since it is recovery, so when the economy is going down, you will find that money supply stand will be this, and when it is recovering or when it is at this level, so it could be at this level here, but when the economy is at the peak, then it is certainly, we call it as it will be contraction monetary policy, and this in the technical sense we call this as pro-cyclical and counter-cyclical, right? So this we often try and touch upon. So I think I have covered most of the things in this particular session, and from here on we will be starting understand the communication side, and I want to spend one session on this because this is a new thing and some of you may be trying to understand for the first time. So I am sure you will be having some idea about it, but it's good that we'll be touching upon this issue in the next session. Let me summarize what we covered so far in this particular session, that we went for understanding the unconventional monetary policy measures. We went for from the spot operation to we went for the targeted liquidity and refinance facilities. Then we went for the long term repo operations, and then we also went for the targeted long term repo operations and so on, and then especially special long term repo operation. So all these things are helpful, and this is the comparison sheet. So overall what we have understood in this particular session is about the interbank setup, different types of measures, how it works, and why interbank system is important. Then in this particular session, we also touched upon some of the basics about the communication, how communication of the central bank is crucial for the commercial banking and also for the fintech. So this will be continuing in the next session. So I'll be stopping it here. Thank you. Thank you so much. Thanks for your attention.